Welcome everybody to We Help You Raise Capital, brought to you by CFO Centrum and Cap Expand Partners. I'm your host, Chris Templeton, and we will get rolling in just a moment. Welcome everyone, and thank you for being here. I'm your host, Chris Templeton, and I'm really happy to welcome you to We Help You Raise Capital, brought to you by CFO Centrum and Cap Expand Partners. I'm really pleased to welcome to our talk today Sergio Van Looyk, Managing Partner of Cap Expand Partners. He's the Senior Advisor at Deventures, previously responsible for PwC Corporate Finance M&A on the M&A advisory team. And Dirk Vergruben from CFO Centrum, part-time CFO, co-founder of Sustainary Group, and a guest speaker for Sustainable France. So I want to welcome both of you. Before we get rolling, we want everyone to know that you can ask questions during the presentation. Sergio and Dirk will be presenting for about 30 minutes. And during that time, if you have questions, please go ahead and add your question in the chat box, preceded by a Q or a question, so that we know that that's what it is. And we will get to those after Sergio and Dirk provide their input for today's meeting. The agenda is to talk about preparing an investor-ready business plan and deck, determining your capital needs and funding mix, defining matching investor groups, and effectively reaching out to investors. And after Dirk and Sergio speak to that, we'll open it up for questions. But again, please feel free to add your questions to the chat. Please precede it with a capital Q or question, so we know that you've got a question that you want to ask. Thank you again to everybody for being here, and let's get rolling. I'm really pleased to introduce Sergio Van Looyk and Dirk Vergruben. Welcome, gentlemen.
Thanks, Chris.
Thanks a lot, Chris. So Sergio, you start or I start?
Please go ahead. Beauty before age, or age before beauty, one of the two.
Okay, Sergio, thanks. So thanks a lot. I'm very excited that you are all participating to this unique, let's say, the presentation. Why is it unique? Because we are combining the knowledge of a part-time CFO with the knowledge of an M&E expert, and normally it's either one or the other you will engage for capital raising. So I'm working for the CFO Center, so we are present in 18 countries. And we are having more than 700 part-time CFOs working for us. And they are helping companies, especially SMEs, scale up companies and all those kind of stuff. So we are working as part-time CFO, and a major task is how to raise capital. So a lot of companies come to us and they say, Dirk, how can we raise capital? And often they only think about equity because it's in the market. They see there are a lot of capital fundraising exercises with success. The ones that don't have success, they don't hear it, so they think it's very easy. And I said, why do you start with capital? Because first you will, let's say, dilute your share capital, you can lose control. So first do the normal exercise. So the normal exercise to do a capital fundraising is do your homework first with your CFO or part-time CFO. Start with your business plan, let it be challenged by your CFO and all the other people that you know to see if your business plan is clear and really clear ready there. We make it sexy for investors. That means we will write it in order that it applies to the normal modern business requirements that investors are interested. For instance, digitalization and sustainability are key keywords at this moment. Then based on the business plan, a financial plan is created, you write yourself or we help it. And then if that financial plan is ready, and especially the balance sheet and the working capital needs, because that's often forgotten, then we see how much capital you need. You need 500K, 1000K, or you need 10, 15, 20, 50 million. And then what do you need for? You need for go-to-market, investments, and all those things. So, and when we know that, then we will advise a financing mix. Financing, equity, bank loans, factoring, what you need. So we have a portfolio of financing techniques before you can go or consider equity or do it in combination. We have bank loans, investment loans, special real estate loans, and we have very good experts in the CLV Center for, let's say, real estate funding, leasing, financial leasing, renting, rental, you name it. We have special factoring things, and for the Belgian audience, it's not only the Belgian banks who can factor, but we have a lot of international companies that are even better in factoring. We can apply official loans for official, let's say, institutions like PNV, let's say, Participatie Maatschappij Vlaanderen. We can have look and think, we can see what is the effect of crowdfunding. I'm an expert, I can say, for sustainable finance, circular finance, long-term rental contracts, you name it. So in that way, we can help you a lot. But if, let's say, we see that your financial and business plan is not only, let's say, supported by loans and, let's say, the non-equity things, then for surely you need equity. And then, of course, me as part-time CFO, I know a lot of it, but Sergio, he is the real expert. So, and that's the reason why we work together with Sergio. So, and now I give the word to Sergio that you can explain me about equity. But of course, you said also you do, let's say, loans. You do more than equity, but you will explain it, please, Sergio. Go ahead.
Absolutely. And perhaps a quick intro from my side. Thanks, Dirk. Background in corporate finance, for the sense of the word. I started my career at a mid-market boutique in Amsterdam, New York. I was one of the first employees at Leonardo & Co., which in the Netherlands grew out to become an organization of 10, working on 100 million plus M&A and financing transactions. The company got acquired in Belgium by Rothschild, and the rest of Europe by Houligan Lokey. I also have in-house M&A corporate development experience at Beer Brewery Bavaria, as well as precious metal recycling and EV cathode production manufacturer Umicore, Belgian listed company, where I was responsible for a number of divestments and financing propositions. I also have a private equity background from a turnaround company called Business Creation Investments, before moving on to becoming and leading the team at PwC Corporate Finance in Belgium, and currently operating under Capexpan Partners with a team of 5 from Belgium, focusing primarily on transaction, 50% cross-border, 50% focus on the Benelux, helping companies acquire or sell a part of their company, as well as raising financing. Essentially, we're a family office, leveraging our family office network and investor base to help entrepreneurs in the mid-market. And by the mid-market, I mean between ticket size of 5 to 100 million, and raising capital in order to accelerate the business plan. So that's kind of my background in a nutshell. Coming back to Dirk's point. So absolutely, yes. I mean, the reason why we're here together today, I think it's because there's a certain amount of complementarity and as with regards to our service offering. And Dirk's involved at a much earlier stage, at some point when capital is needed, then that's where really I come in together with our team, and we offer and look for customized equity as well as debt and hybrid solutions for helping companies to grow on one hand. So growth equity is an important one. I think another important customer segment or types of clients that we help are people who are not yet ready to retire but want to safeguard a part of their wealth and have a pre-exit in order to safeguard their wealth, continue to grow, and then sell their company at a later stage in 5 to 10 years after having a team on board, an external financing partner to help professionalize our organization. But I can come back to that in a bit. But that kind of dovetails with what Dirk is background is and what he focuses on. Chris, over to you.
Thank you, folks. Nice job. Let's talk a little bit from the standpoint of preparing an investor-ready deck. What are the things that you want people to know they should be seeing in a business plan and a pitch deck?
So I start because I have the limited input and you have the broader input, Sergio. So I just say, let's say for us, as I said, your business plan and your pitch deck should be sexy. That means we have to make your company attractive. And let's say you have always the business side, let's say the economics, the financials, the business thing, but also the human interest. An investor is a human, and he has to like you, he has to love you, you know. Yes, Chris, you know it. We are human. So in that way, I always said your business plan and pitch deck should be sexy. And they have to like you. They have to like your team and things like that. So don't forget that. So your pitch deck should also be easy to understand. Warren Buffett said, I don't invest in companies I don't understand. So it should be easy. You should know in 2-3 slides. What are those guys do? Who are those guys? And what they need my money for? So that's the only thing I want to say, Sergio, but you are more the expert in investment memorandums, in pitch decks and all that kind of stuff.
Yeah, so the term sexy, Dirk, obviously has nothing to do with the original definition, but for us, indeed, what we see very often is a discrepancy in between the financial projections versus the narrative or the story that is basically substantiating those financials. So, you know, what do we really mean with an investor-ready business plan and deck? You know, first of all, an investor needs to understand, you know, what are they stepping into and what are they going to get out of it. So entry and exit considerations are key. I see a lot of business plans on a daily basis, and there's no consideration as far as the exit part is concerned and what this could mean really for a potential investor. And so I think that's an important one. I think another important point I would like to mention is the fact that the capital requirement, and I may be jumping ahead of the agenda here, but it all starts with the business plan, right? And we see a lot of hockey stick type of business plans that have top line projections, which are simply not in line with the historical 3-year actual financials. And that quite simply raises a lot of questions with the investors there who we speak with. So that's where we try to analyze, challenge, and really try to understand, okay, so if we're assuming this in the business plan, you know, how does that compare to the actual story that we're presenting? And then maybe the last point on that, Dirk, and then I'll hand it back over to you and Chris, is an investor-ready business plan, at the end of the day, needs to be tailored to the investor group or the investor type. Are you writing it for an angel investor, a VC, a family office, a buyout fund? I mean, all of these things need to be taken into consideration. So who's your audience? And that, I think, is a key fallacy that I see with a lot of business plans, that it's too generic and does not tailor to the audience.
Yeah, I fully agree, Sergio. Let's say it's a very good comment. So, and that I want to also to let's say add. You let's say we don't have to do anything, but I advise everybody put the golden word sustainability in it. There's a lot of money available in the world, but don't think you will get it easily. Easy money is for, let's say, governments, let's say the European banks. They want to put their business in sustainable business. And there are a lot of impact investors. And I say always, if I'm a business angel, I want to say in the weekend during the barbecue to my grandchildren, I just invested in a new exciting green company. I will say that I invest in the latest war technology or in the oil company or in the sweat shops in Vietnam. You can't say that, and you don't want to say that. So sustainability is very important, and it starts, of course, sustainability starts with sustainable financing, sustainable EBITDA, recurring EBITDA. So the world in sustainability is not far further, let's say, completely aside from the normal business world, but it's a more or broader vision where you have to really please your, let's say, stakeholders. So in that way, we have also a lot of experience that we can support you. So Chris, do you still have questions for us?
I do, but let me just go through a couple of things that I think are important to just cover in what you both talked about. Number one, make it personal. And that is about tailoring it to the investor group, the angel, whether it's an angel investor, a VC, a family group, and make sure that what you're doing is not presenting the hockey stick approach that shows that you haven't been growing the way that you wanted to. And now with your investment, everything's going to be perfect. We need to find that personal place, don't we, that makes sense to the investor, and making sure that we are going to pitch correctly based on who we're pitching to. And obviously sustainability these days is bigger than ever. Okay, next question. How do you know when your business is ready for investors? How do I know as a business owner, oh man, it is time? And when should I start thinking about that?
Yeah, also the first input of me, because Sergio knows it better, but let's say they always start too late. they start to raise capital when they need to pay the let's say the salaries the end of the month, and they don't have money, and the banks don't want to give you the loan. So in that way they say, Dirk, can you raise money in 2-3 weeks time? I said, no, guy, sorry, but I'm not, let's say, a sorcerer. I'm not a magic guy. I can do a lot of magical things, but 2-3 weeks, it's very difficult. So preparation is very important. Take the time for do your homework. And at what moment, I think, Sergio, you know it better, what are the critical moments that you can consider capital raise funding raising?
I fully agreed, Dirk. One of the pitfalls, I think, and one of the expectation that I try to manage is the realistic timing that is required in order to raise capital. Just like you just said, very often I get the question, you know, can we raise capital within the next 2 to 3 weeks? You know, that simply isn't possible. I mean, obviously there's differences in ticket size. I mean, if you're talking more mid-market 5 million to 100 million in the market where I operate in, you're dealing with more institutional type of investors that have a certain way of screening quite rapidly if you do end up on the top of the pile, whether the opportunity fits or not. And if it does, then they can act quickly. I mean, at the end of the day, this is the bread and butter of a institutional investor, right? Buying and selling. When you're talking about smaller amounts, 1 to 2 million, kind of more early stage, the types of investors we're really referring to are or that are associated with those types of investors. It could be VC, but could also be family offices, or some sort of syndicates of private investors, and that takes much more time than 2 to 3 weeks in order to organize. And so that's where we try to manage the expectations. And if it's something that a business owner waits for until the last moment, then when it's necessary, that's oftentimes the time when it's actually too late. So it's about thinking and planning on a periodic basis, and that's point 2 really on our agenda, is on a periodic basis updating your business plan to really force you to think about your top line growth, your costs. Are you talking to the right vendors? Is the right IT provider or the right bank basically supplying you with their services? Are there ways to cut costs? But at the same time, it forces you to think about liquidity requirements if you do it on a periodic basis. And so that's, I think, a critical point, that you really need to do this on a periodic basis so you can already get a alert up front in terms of when you need that liquidity. And if you realize a couple of months ahead of time that you're going to run into trouble based on realistic assumptions in your business plan, I think that's the time to really start thinking about external financial partners, to the extent that you do not have that liquidity or the solvency or your own sources of capital internally. There you go.
Okay. Very good, Sergio. This reminds me, a lot of companies and people are forgetting the need on working capital. They have needs, or let's say funding their business, funding their, let's say, innovation, go to market, factories, all those things. Don't forget working capital, and discuss with your part-time CFO how you can optimize working capital so it's also scalable. That means if you grow your business, you don't eat working capital, because working capital funding is very difficult. So in that way, don't everybody underestimated the need of working capital. Okay, Chris.
So here's a follow-up question on that, gentlemen. And Dirk, I imagine you probably see this sooner than Sergio does. We talk about when it's too late, I need to pay my people, versus what are the things that you see as a part-time CFO where you want to say to a business owner, it's not in the near future, but I think maybe now is the time to start getting our ducks in a row to look at funding down the road, whether it be through capital or through loans. What are some of the things that you see that are triggers for a business owner to start thinking about these things?
Yeah, let's say first you have to make a good financial plan and to see what are your, let's say, funding mix. But for instance, one of my customers was a renting company of audiovisual material, let's say LED screens where you can watch the football on the market of your, let's say, your city. And there they were funding it with leasing, but for each leasing they need 15% or 20% own money. So, and I said, guys, within 6 months, you don't get it leveraged anymore with your leasing companies or banks. So we have to put there something in. And then there I put in a mezzanine loan, so a loan let's say, a subordinated loan from a government thing, and in that way they get some, let's say, semi-equity, which we can use for leveraging again bank loans. So normally you have to think about, you have to have 3 to 6 months, even if when you go to the normal banks and things like that, it takes time. So, and what normally, Chris, when they engage a part-time CFO, it's already too late. So we have always to get up our, let's say, get up, and we be very, very fast. So, but still, so it's a bit between crisis management and strategic development. But if you need money today, we have to see that you get money today. But it's, yeah, let's say, so we have the tactical fundraising and the strategic fundraising.
Sergio,
so
anything you want to add to that?
A pain, but it's always a pain, Chris.
Sergio, what else would you add to that, sir?
It actually reminds me of a slide that we often use when we talk with our clients, right? And it touches upon a lot of the topics that we're covering today. So the first port of call, which is often forgotten, when you talk about trade financing, talk to your relationship bank. What are they saying? If you're considering expanding, if you're considering an acquisition, if you're considering, internationalization, talk to your relationship bank first, see what they can offer. But, one of the things that you have to realize is that, they may provide you with the money, but the strategic contribution is going to be limited. And in any case, it always makes sense to talk not only with your relationship bank, as well as other banks, in order to be able to compare interest rates, which is obviously a topic of discussion nowadays. What I see very often is that entrepreneurs, business owners, they tend to look at equity type of solutions, which is fine. And under certain circumstances, an equity investment or capital raise is and could be the right option. Who could provide this? VC funds as institutionalized investors, as well as family offices. But also the difference between these two and the nuances, I think, are extremely important, and perhaps we can come back to that in a bit. But what I notice very often, the investment group or segment which is overlooked and which is really a growing market, originating from the US, where probably over 50% of the total value exists at the moment, is the private debt market. And the private debt market are non-bank alternatives, and they're touched upon this point when speaking of mezzanine. Also applies to acquisition financing and further growth financing, are hybrid debt equity funds or debt funds that basically provide a subordinated debt. And by that, really, I mean, in terms of the pecking order, they do not ask for collateral. So if your company would go belly up, then basically the bank would get paid back first, then the subordinated debt or shareholder loans or mezzanine or whatever hybrid type of debt you have, and then your preferred shareholders, followed by your common shareholder, which is the typical pecking order. And it's this particular point with regards to hybrid debt and equity funds and debt funds, which I think is often overlooked. And why is that important? Because they can also provide the funding that you need to accelerate your business plan. However, you have much less valuation discussions, sure, the interest rates are going to be comparatively higher than those of the quotes that you're going to get from bank financing. They may even ask for some sort of an equity component or a warrant at the point of an exit. But it means that, in fact, you could attract external financing without diluting. And that's, I think, something important to consider. Can your company pay back and basically service the debt, or is equity a better solution? And are you more in that stage where you do not have sufficient cash flows yet in order to go for an equity component or an equity solution?
One of the things
Sergio, I fully agree. So let's say people, I said, Dirk, we go for equity. I said, let's start with subordinate loans, try to convince some people to get some subordinate loans. So then we can postpone the capital funding raise for equity, and you create more value, we have more time. So if we can, for me, the magical word is also, if possible, support the subordinate loans. Convertible, yes or no, but we have to see. So Chris and Sergio, I think we can still speak for ages, but I think it's very important that we will also handle the questions. So what you think, it's time for questions, or do you have other ideas?
I think we got just a couple of quick things that we want to cover first. Sergio, one of the things that you just had up was kind of looking at the funding mix, how to determine the funding. Let's talk a little bit about what that process is, and how you decide what the needs are and where they'll come from.
That's the short answer there is it depends, obviously. And by that, I mean, first of all, it's a matter of establishing your capital requirements based on your business plan, your liquidity, the cumulative future liquidity needs that you have. Now, having established that and knowing what you're going to, and being able to for whatever financial partner you're going to actually use those funds, is it going to be for certain operational matters, or do you need a buffer or whatever? I think it then comes down to understanding, okay, what is the value of my business? And that's a completely different chapter. But, when you're talking about equity investments, that's something I think to consider, and to have a professional really determine also, what's the value of your business, or more specifically, your equity. So that's, I think, a point to consider, because at the end of the day, a capital injection implies a pre and a post money valuation. So what percentage are you given in exchange for that stake? Last but not least, what are all the terms and conditions that are associated with that stake? That's one. And two, it depends also on the cash flow generation capacity of your business. If you can provide a credible business plan that shows that you can service the debt in a kind of a solid kind of base case or bank case scenario without any exotic assumptions, that's the part that you should consider financing with debt. But obviously you have to realize that, contrary to equity, goes without saying, you're going to have to pay for that interest. It could be in cash or payment in kind at the end of the day, meaning at exit. But it could also, and the distinction there with equity is that obviously you don't have to pay those, that or service that debt in the same way. Of course, there's exceptions. You could have regulations and governance procedures and shareholder arrangement with regards to a dividend. But in a nutshell, it really depends on that business case in order to determine that right mix of equity versus debt.
Yeah. So Chris, I want also to add, let's say, what Sergio said is 100% pertinent. But what's also important is, what do your funders like? We know our factoring companies, we know our leasing companies, I know the governmental companies, and I know what they like. And in that way, I can, let's say, make a creative funding mix. And I said that we can use for factoring because that factoring company will like it. We go to the bank, we can use the factoring contract as a collateral. But that's a bit, I know what Look and Fin, for instance, in Belgium, they like really determined cash flow. So in order, let's say Sergio knows all there is investment partners. So we know what they like, and based on what they like, we try to seduce them by, let's say, asking the right questions and the right funding mix requirements. So that's a very important point also. Know your investors.
The thing that also comes up for me is, what are the things that businesses really make big mistakes on? What are some of the common mistakes when it comes to figuring out the right mix of funding?
Yeah, let's say go for equity too soon. That's the most important thing. Just concentrate on equity. That's a big thing. And let's say, start with your bank, but let's start with your home bank. And everybody said to me, Dirk, I already spoke with my home bank, but with what plan, with what financial projections? How did you consider them? So, and often I go back to the bank and they give a loan, so go with the fundamentals, start with the fundamentals, see that the fundamentals are there, and do it back step by step of this thing. So what errors do you notice, Sergio?
Yeah, I fully agree that, Dirk, I think maybe to add, I touched upon the point earlier, I think it's the tendency, one, to always go towards an equity solution, and very often too late. I think that's one. I think two, in terms of defining your capital needs or the ask, at the end of the day towards an investor, is something in a pitch deck or an information memorandum that I do not see coming back in the actual financials. So how do you substantiate it, and to what extent are the projections, and that's coming back again to the business plan, how are you substantiating the capital needs, and what's it going to be used for? So I think those kind of points are important to, or some of the pitfalls that I see when determining the capital needs.
Yeah, and with the pitch deck, to be honest, most companies only think about themselves. They are explaining what they're doing. They are very proud, and sometimes they should be very proud about themselves, but they should think about the market, the customer, the potential user. They should think about, if you want to be sustainable, to a lot of stakeholders, customers, let's say suppliers, personnel. They should also think about the investor. They should put themselves in the shoes of the investor. So don't think about yourself. And when you make a pitch deck, let it be challenged to a lot of people and think, what do you think about it? So you have a broader view that what the external world think about my business and not what I think about my business.
I think you touch upon a relevant point there, Dirk, and I don't know what your thoughts are on this, but what I see very often is that immediate kind of tendency to go out into the market, whereas very often it could really be, and that's more your territory, it could very often be a matter of looking first at your own business plan to see, okay, to what extent can we fund our expansion internally, right? The more urgent it becomes to raise capital, investors are going to see this, are going to sense this, are going to smell this, so they're going to offer you worse terms. Right. So trying to see internally in terms of working capital, what you could optimize in terms of cost savings, what we touched upon earlier, your vendors, your other types of SG&A expenses. Look at that first.
Fully agree, Sergio, and that's what I also said about working capital. So see that your credit collection is really done properly. Do you advance payments for contracts? Do you use direct debits? Do you, let's say, optimize your inventory? All the normal financial stuff of a CFO. Just make that, because then your ratios will be much more sexier. I again use the word, but it's like that. Also, the next step is, do you have customers who are willing to invest in your business? Do they want to give you advance payments? Your suppliers, they have a very interest that you grow your business, because then they can deliver their products. Are they willing to give you loans or whatever? So just stay very close to home, and then afterwards go to the external world.
Nice job, gentlemen. Let's move on to how we define a good matching investor group. Let's talk about how you define the right investors for your business. Sergio?
That's I think a key question. After you've prepared your business plan, indeed, you know what your capital needs are, what you're going to use it for, what your funding mix is going to be, because at the end of the day, that determines the type of investor groups that I showed previously on the slide. I think, it's actually, in that sense, simple when you talk with institutional, again, between 5 to 10 to 100 million ticket sizes. Those types of investors are really going to screen your capital raised on a couple of factors. That's basically geography. Does it match with their criteria in terms of investment size or ticket size, and in terms of type of activity, as well as the stage of the company that you're in. So these are factors to take into consideration, because that whole kind of capital provider universe, be it debt or equity, that's already going to determine and create certain constraints and create subsegments as far as that's concerned. And then obviously the capital ask, if it's 1 or 2 million, is going to be much more different to when it's 15 million. So I saw one of the questions before, which I think is highly relevant. It takes just as much time, if not less, to raise 50 million than it does to raise 1 million. And that has to do with the fact that you're dealing with different investor groups, right? One of the things when we're talking about defining matching investor groups is, what do you want them to contribute besides providing you with a bag of money, right? If you want a bag of money and your bank can provide it, and that's all you want, great. But if you want some sort of a strategic contribution in order to have a party on board, a financing party on board that can help you, and in a complementary way to expand internationally, in order to realize different revenue sources, whatever the case may be, look and really at the type of investments that have been made by the different investor groups. I think that's one, and maybe two, to kind of wrap up on this point. If you're looking for a more hands-on, are you looking for a more hands-on investor, or are you looking for a more hands-off investor? The question that I get very often, because of our context with family offices, is, do you know, Sergio, of a family office that would be interested in financing my business? And what they have to realize, and what I always tell them, is that it depends. On one hand, families have a certain type of preference, which is much more subjective to the criteria and the boxes that I outlined before. And typically they're also more passive investors, long-term investors, offering more flexible solutions and more difficult to access. I think relationships there are key. They could be the right investor group for your business case. However, you have to realize that the ticket size, if the investor, even though they might, the family office may know me, they still don't know, in a case of a direct investment, my client. And so that click, that personal relationship, I think is key. And they may start off with investing in just a small amount, 250K, just to test the waters. But you also have some that are less risk averse and may go up to 2, 5, 7 million, obviously depending on the overall assets under management or wealth that they've accumulated.
Yeah, indeed, Sergio. So Chris and Sergio, can I put a small commercial between the lines here? Let's say the relationship with the investors and the banks are very important. So, and for some investors, if they know I am the part-time CFO, or we have a CFO, the CFO center, they're more willing to give financing because they trust us. They know the finances are handling well. They see what to get. And of course, if after 6 months or 1 month, a year, it doesn't appear to be that good, they can blame us, you know, so we don't disappear from the market. We have a reputation, so we have a reputation towards our customers, also to the fundings and the banks, of course. So in that way, yeah, okay, if you have your own CFO, it's also very good, but we know a lot of the guys who have a lot of money, of course.
Yeah, and maybe to add, sorry, Chris, to interrupt, maybe to add, I think this is it touches upon point 5 of the agenda, effectively reaching out to investors. Are you going to do this yourself? Are you going to use the help of an external advisor or party? And, it goes without saying, if you have a warm relationship with an investor, that's great. But if you can partner and team up with an external advisor who has the relationships with the said investors, it is, and it's a credible advisor, it is really going to speed up the process, right? And they see a lot of investment opportunities come by every day. They have to sift through them in the way that I mentioned before in terms of criteria. So, and to avoid kind of your investment proposal ending at the bottom of the pile, what really helps there is a direct connection with the relevant investment members. And then we can get into what's behind that, the investment committee, the credit committee, et cetera, and all the layers. But as a first step, I think this is key.
Relationships really are one of the most important things to be considering. And it seems to me at some level, somebody like Dirk is going to be creating some of those and working on those relationships, especially initially through banks. And when we start looking out a little further and looking to equity, as well as banks and larger numbers, then we're moving to Sergio. Am I on the right track there?
Yeah, in broad lines, yeah, we have a mix and a combination because Sergio has also good contacts with banks and other financial institutions. I know. So let's say it's more the specialization of Sergio, it's equity and those VCs, and I have more the specialty, but we know the both, And of course, Chris, we have to emphasize Sergio and myself, we are your golden team. Our combined experience and things can make, so 1 + 1 is 3 or 4, in this exercise.
Well put. What we're going to do now is move on to questions. If you have questions, feel free to add them to the chat. Please put a Q in front of them so we know that it's something that you want to address now. We have about 10 minutes left. I just want to give everybody a heads up that we'll cover as many questions as we can in that 10 minutes. And then anybody that wants to continue, we will continue to cover questions after the 10 minutes are up. So let's take a big step back and talk about sustainability. Are you saying sustainability is good and impact is less good, or are they both good?
Yeah, for me, it's the same. I don't know if I'm right or not, but for me, it's the same. Let's say sustainability is all about how can you have a huge positive impact on the SDGs. The SDGs are the Sustainable Development Goals of the United Nations. It's all about impact and positive impact. So let's say sustainability for me, impact investing. So just to have a positive impact, you know. So let's say, yeah, be good for the society, the earth, the environment. So, and don't think only about yourself, but think about of us all.
Yeah, and I think maybe to add to that, with regards to a couple of real life cases, as I said before, I work a lot in the kind of direct investment space with family offices and direct investment vehicles. And so, yeah, if I approach them with a case that is focused on liquor, spirits, that very often, because they, these contacts who we're speaking to, obviously, in the case of a direct investment fund, they have their limited partners, their LPs. And what you're seeing is what Dirk is saying is that very often they have already certain kind of constraints that you're just not going to be able to bypass, in terms of their initial and preliminary screening of that particular case. There are, of course, investors that are interested in spirits distribution, but as Dirk mentioned, you keep and enlarge the relevant investor or community for your business if there's an element of sustainability concern. Well, obviously sustainability, Dirk, I mean, that's I think a whole chapter and different. We can spend another hour on what that exactly is, but ESG is in my experience, a prerequisite to take into account.
Yeah, I fully agree. And let's say, surprisingly, as also said Chris, he said it's an evidence you think about sustainability, but everybody thinks about it, but nobody really understands it, if I can say it frankly. Because when I speak a lot of companies, they say, oh, I'm very sustainable because I have a lot of Tesla company cars and I have solar panels on my roof. And I said, okay, let's start again. So it's all about impact or what you're doing about the SDGs. And you have a special sustainable financing area with non-financial reporting requirements, with GRI reporting and other reporting standards. You have another type of impact investors, and you have a lot of other special financing techniques like circular financing, let's say a peer-to-peer financing, also blockchain is coming in. So we are entering in a completely new world. And it's very exciting. So yeah, as Sergio said, it's a complete different chapter. And if there is interesting, people are interesting, we can organize a new event about it.
Let's talk a little bit about what the vision of investors is, especially when it comes to private and social projects. Can you talk a little bit about investors and their interest in these types of things?
Go ahead, Dirk.
Oh, yeah, let's say the social point, let's say, I know impact investors who are only willing or eager to invest in there is a social benefit, positive impact. So it's, yeah, let's say, they are very interested in how much impact you can provide to have your positive actions concerning social matters, So social matters, for instance, people with a distance to the labor market, as we call it. Let's say people, let's say gender equality. Yeah, you have a lot of, let's say, the SDGs are a bit summarized in the ESGs. So you have environmental, social, and government. So the social aspect is a very important aspect, So yeah, let's say, yeah, it's it's a broad area. So I have to know more specifically. So the person who has asked the question, you have to be a bit more specific afterwards, or you can contact me that I can see what kind of social private investors is meaning to.
Sergio, anything you want to add to this in terms of private and social projects?
The only thing I would like to add to what Dirk said is this is not so much a service or solely a service offering proposition matter when we talk about sustainability. It's not necessarily an industry related topic. When we talk about ESG, we're talking about, on one hand, what are you offering? Obviously, selling an oil and gas business or raising capital for oil and gas business in current time is going to be more difficult than a solar panel or other renewable type of energy business. But the point I'm trying to make is it's not just that top line, it's also all throughout your P&L and your balance sheet and your value chain. These are areas that also account and you should take into consideration when we're talking about sustainability.
Yeah, and if I can add to Sergio, Chris, let's say when I speak about sustainability, I said watch out for greenwashing because you will be subject to green bashing. That means if you claim you're green, everybody will jump on you and say, oh, guy, you are really pretending you're very concerned about SDGs and ESGs, but in reality, you don't do nothing. So I don't trust you. You're a liar. So, and it's really, I often advise my customers, be really, let's say, very prudent, because if you start with more sustainable business, do it good from the first step, because everybody will watching you. If you're a really polluting company and you don't do about sustainability, it could be that they don't watch you. But if you said, I'm polluting now and I want to be less polluting, and you make it on your website and pretending it, watch out, because they have noticed you and they see if you make errors or not. Just example in Belgium with Solvay, they're a state-of-the-art sustainable company, and there's a lot of criticism or of an, let's say, how you call it, an investor who is challenging their factory in Italy. Yeah, okay, so that's life, so be very careful.
You don't have a share in Solvay, right, Dirk? Just
no.
Okay. Sorry, Chris, go ahead.
Nice job on those. Okay, let's move on. How does the conversation differ when a founder is offering an investor a loan repayment versus equity? How does the conversation differ?
And that's actually the point that I was didn't have time to get to, but if you're talking with a bank or with a debt provider versus a equity provider, you have to realize that the person, your first point of contact at these companies or these firms are not necessarily the ones who are going to decide, right? There's different layers very often, and when we're talking about more institutionalized capital providers, when we're talking about credit providers, be it bank, non-bank financing solution, they have a credit committee, right? And the credit committee is really going to look at the balance sheet, your debt service coverage ratios, all those nice things that need to come back and need to be substantiated in your business plan. Because at the end of the day, the debt provider, forget about the warrant for a second, they only have a slight upside, but a lot of downside, right? And that's something that a credit committee is going to look at in extreme detail. If you compare this to a equity provider with an investment committee, they're just looking for the next jockey, for the next winning horse. Sure, the story needs to be credible. The equity story and needs to be credible. So the plan, how it's substantiated, the go-to-market strategy, whatever you're presenting or whatever your contact has to defend towards an investor committee. I mean, that's really, really key. And one thing and one question I would always ask when talking with a potential capital provider is, what does your internal procedure look like? Is your investment or credit committee involved at an early stage, yes or no? Because they're going to be the ones who are ultimately going to decide.
Yes, I fully agree. And so let's say, in general speaking, let's say a loan provider, he's interested in payback capacity. You have to be able to pay it back at the right time. So cash flows, confirmed cash flows, it's very important. Let's say equity, it's creating value. Let's say they enter at, let's say, a price of 100 and they want to exit in 3 years at a price of 600. So it's value creation. And if you have a really, let's say, long-term investor, he gives you a long time to do it. Of course, you have also long-time investors, which takes 5 or 10 years. So in that way, you have much more time to, let's say, create the cash flows and EBITDAs. Depending the loans, if you have investment loans, you can also have loans of 10 years. So it's a completely different thing. As I said, Sergio said, loans, they have a lot of downsides, so they are very careful. With equity, they're also very careful, but let's say the upside is enormous. They go for, let's say, the jackpot, you know, each time they want to have the jackpot. So they have a downside, but the upside has to compensate a lot their risk they are taking.
Thank you. I want to just at this point say thank you to our audience for being here very much. It's a touch over an hour. We're going to keep going, but if you are looking for help, when I think about how I want to summarize what I've heard over the last hour or so, number one, start early. Start thinking about funding early, not when you're in need, because it's going to be a much harder sell. Number two, pitch to investor goals. Think about what's in it for them and spend as much time, or at least a fair amount of time, making sure that you are pitching to what's important to the vendor, or to the investor that you're pitching to, or bank, and also that you are looking at different investors through their eyes. So your pitch needs to change. We don't want it to be generic. Be authentic. If you're going to be say you're sustainable, be sustainable. If you're not going to be sustainable and not having a bunch of Teslas in the fleet, don't pitch that. And I think the thing that's most important is that you talked a little bit about, Dirk, is, you know, people are watching you, but the people that are watching the most are the people that are investing in your organization. So be authentic. And then the last thing I would say is relationship. And when I think about, you know, what Dirk and Sergio bring to the table, it's those relationships. It's those abilities to talk to your banker, to talk to investors in ways that are going to make you shine, because you're getting not only the value of the relationships that Dirk and Sergio bring, but their ability to pitch to those investors and bankers in a way that's going to make sense to them. So that's my wrap up. Thank you so much for being here today. Sergio Van Looy, managing partner at CapExpand Partners, and Dirk Vergruben from CFO Centrum. Thank you both for being here and doing this. We're going to continue on with a few more questions, but for those of you that need to go, thank you so much again for being here.
Great, Chris. Thanks. And for summarizing it, you could have basically just shortened this session to 10 minutes.
Yeah. So next time, Chris, you will do the session by yourself.
I'll take care of it next time. Yeah. No, I don't think that's quite how that's going to go. Okay, let's move on to another question.
May I propose we do 3 questions, and you know, also to respect other people's time.
Yep.
Happy to also answer questions that are unanswered, right, after the session, you know, either by email or whatever form is most appropriate.
And good point. Be sure and put your email in the chat so that we can forward you links to the deck and to this recording. And we'll move on with a couple of 2 or 3 questions. Here's one we currently manage around 12 million in assets, but we'd like to grow our AUM to 100 million. How do you think a small fund manager should raise capital, or what is the best way to raise AUM?
I can take that one. It's not an easy one. Not sure exactly I'm assuming that the person who's asking this question, I don't know what his name is, Chris.
I don't have that in front of me. I'm sorry.
Oh, sorry. Is involved in some sort of wealth management or family office service segment or private bank. From a capital raise perspective, if you want to increase your assets under management, I mean, there it's really about building a pipeline of limited partners or families or institutions, getting access to the right people. And in fact, and that whole process is not too dissimilar to a sales funnel that you would see with customers, right? Because obviously there's relationship, but at the same time there's also safety in numbers, right? And I think it's important to try for yourself to build networks and go to the relevant conferences to actually speak to the relevant investors who would be interested in your services in order to increase the magnitude of AUM, so to speak. Approach them through introductions, your ideal type of investors that you could serve, and really use social media, LinkedIn. That's where you're going to find a lot of them. And to the extent that you kind of get through to them, consider talking with relevant advisors, trusted advisors, reputable advisors that will be able to accelerate this process. And again, it's much like a typical customer funnel, but then when investors, you need to manage this properly, right? Because out of the 100, maybe one or two will eventually convert.
Dirk, anything you want to add on that one?
No, not really, Chris.
Okay.
I'm in line with Sergio, so no problem.
Okay, I've been told that people like smaller amounts less as it takes the time to assess big amounts. Are you saying this depends on who you go to? And I know you covered this a little bit earlier, Sergio, but give everybody a little more insight into, how it depends on who you go to and larger versus smaller amounts.
Yeah, perhaps can I handle it to Sergio? Because let's say, so
I'm going to make an executive decision on that. Dirk, it's on you.
Okay, thanks, Chris. Thanks a lot. So let's say, yeah, of course, and it depends about the type of investors. All investors don't like small amounts. It's terrible to raise 100,000K. It's terrible. If a guy asked me for 10, 50 million, I said, okay, with that request, I can open doors. So it's always, and what is the argument of the investors and the banks? We have to do as much as work to fund 10 million than 100K. And we earn much more at 10 million than 100K. So and that's the reason I have a lot of SMEs who needs between 100,000K and 500,000K. That's the worst exercise we can have. You agree, Sergio?
Yeah, absolutely. And maybe to kind of really touch upon I think what is the heart of the matter here is 100K taking the extreme on one side of the spectrum and 50 million on the other side of the spectrum. And you're dealing with different types of investors, angel, family offices, etc., versus institutional investors, right? Whose bread and butter is really to just process and go through this process of basically going to a close if all the boxes are checked. When we're talking about the other side of the spectrum, there we're talking about families, angels, private investors, First of all, you need to be able to get hold of them. You need to make sure that they actually have an affinity with your sector. So this whole process, I mean, that's why I'm coming back to, I think what's the point really here that you're trying to raise is that this part, this side of the spectrum, it takes much more time to align these types of investors, given that they're not institutionalized and they don't do this on a daily basis. So raising again 50 million for one transaction versus a syndicate with 20 different investors, that's going to go, the latter is what really going to be a process that takes much longer.
Got it. Okay. I'm not sure if I'm going to read this one properly, so forgive me if I make a mistake. Sergio, say a business is raising 15 billion for a 5-year runway. Does that sound right to you? Is that a number that's
50 billion?
Yeah, 15.
15.
No. Yeah.
What geography, what activities, what amount that's known, stage of the company, what does the business plan look like? How realistic are these projections? If you want to ask as an early stage company for 15 million, you better be damn sure you have a potential unicorn proposition that's extremely scalable and appealing to the right types of investors, because it's not realistic to expect 15 million for an early stage company without some sort of milestones, being realized, some sort of targets being realized as you go. Yeah, there are exceptions to the rule, but that's a general comment, and really it depends on the phase of the stage of your company. If you're an established company with a track record that has shown in the past, positive cash flows, and you're looking to expand, or again, you need financing, or looking to acquire another company, need acquisition financing, it could well be that the 50 million is quite a lot simpler to raise.
Yeah, and we don't have to underestimate the relationship of the companies. I had a startup company, and the guy said, "Oh, we got a lot of loans of our banks. We don't have problems." And I saw it, said, "It's incredible." And I was doing some research, and I was seeing the founder, a young guy of that startup. He has an uncle who is in the investment credit committee of a major bank, So in that way, he has a lot of relations, and you don't know if there are back-to-back transactions and guarantees and whatever. Let's say when I'm, for instance, the grandson of the major owners of Solvay, I use it again. Yeah, I have another relation and network than a guy who don't know nothing, of course. So, and then in let's say in the media, they said a startup gets 50 million. Yeah, but it's not the normal case, it's something behind. And we know some stories which are very surprising. And so for Sergio, for me, it's difficult because they say, "Oh, those guys, they get 50 million, and now you say it's difficult." Yes, but there are special cases.
I'm saying it depends. It depends on the case and the geography, the activities, and the stage of the company. When we're talking early stage, yes, difficult. When we're talking about an established business with track record, could be, dependent on the business case, but could be easier to raise.
Excellent. Okay, last question. I've bootstrapped my software as a service business, and we're able to develop MVP and have launched as well. Now we are looking for funds for marketing and business development, along with further research and development, in order to develop and integrate more features in it. How can you help us raise our required funds?
Super, just contact us and we will explain you in detail how we work.
Maybe to kind of elaborate a little bit, my first response to that is, And I see that very often with early stage companies. They've developed great features, in a cave, and with great people who are very smart in developing all types of features. The phase that I'm noticing that, and where this question is also coming from, is, okay, we're entering this into this new stage whereby we're actually going to have to commercialize. And then the question really becomes, I tend to break this down in very simple terms. What pain point are you addressing in the market? Where is that market, and what pain point or challenge are you addressing? What's your unique selling proposition, right, compared to other competitors? So does it make sense to compete? And then 3, what's your go-to-market strategy? And that's often the sales and marketing. And where I see a lot of early stage companies, they get very much hung upon the developing and continuing developing without having that connection and understanding what's really required in the market and understanding the competitive landscape, and then really getting the people on board. Are they already in the team, the right people, in order to be able to commercialize? Or do you need external salespeople? But that really depends on the founder, on the team, whether they are the right person in order to be able to scale the concept.
Yeah, and it's often said that the go-to-market costs are always under-evaluated. So a go-to-market cost can cost a huge of money, but you can also use what I call digital sales and marketing. Use all the digital tools, and if you do it properly, you can save a lot of money. And so also Sergio and myself, we have a lot of experience in it, so we can benchmark your go-to-market efforts and say, guys, did you think about that and that? Because it can make a hell of a difference.
Yeah, exactly. I published an article on this on my website. It's the latest article in terms of how to use digital marketing tools to generate leads and also potential targets. It's directed more towards investors. Have a look at it and feel free to reach out, because like Dirk said, tech really helps to accelerate things and to scale at the end of the day.
So for instance, for this online event, we use Shire, the company of Shire. So she is helping us on the background. She has done a lot of lead generating and a lot of making buzz about it. So we use it ourselves, So here, Shire, thanks for sharing your company name. So we are very pleased with this effort. Okay, also you, Chris, you're helping us in that. So we are an example how you can use the modern media for a go-to-market strategy.
Absolutely. Thanks, Chris, for hosting and moderating, and please do share your contact details.
Also,
you've been a great help.
So I agree with Sergio that we don't make a commercial presentation about it, but okay, we are sales guys also. So in that way, that's life.
Absolutely. Really great job, gentlemen. I want to thank again Sergio Van Looy from CapExpand Partners and Dirk Verbruggen from CFO Centrum. It's been a real pleasure. I think it's been insightful, and I encourage you to look up Sergio and Dirk early before you think you need it.
7 o'clock in the morning.
Yeah, there you go. Okay, thank you. This concludes our presentation of We Help You Raise Capital. Thanks so much for being here. Take care.